All right, so today, let's take a deep dive into something pretty interesting. Can you really turn like a small amount of money, we're talking $75, into $1 million?
Whoa, $1 million.
Yeah, $1 million. That's life-changing money, right? And the article that sparked this whole deep dive is called, get this, Comment Transformer $75, La magie des investissements passifs, which basically translates to how to transform $75 into $1,000,000, the magic of passive investing.
Ooh la la la.
I know, right? So if you're the type of person who loves learning new things and you're not afraid to crunch some numbers, well, this one's for you. We're going to break down how, with some smart investing over time, that $1 million dream could actually become a reality.
I love it. You know what I find really interesting about this article? It's not promising some like get-rich-quick scheme. It's all about the power of consistent investing over the long haul.
Okay, so let's we'll break this down. The article starts off with a pretty compelling example. It says if you invest just $75 each month into a fund that historically has around a 10% annual return, you keep that up for 40 years and boom, you could be looking at $1 million. Is that really how the math works out?
That's the beauty of compounding, baby.
Compounding.
Imagine a snowball rolling down a hill, right? It starts small, but as it picks up more snow, it grows exponentially.
Okay, I'm picturing it.
It's the same principle with investing. Your initial investment is like that tiny snowball, and the returns you earn each year, they get added on, creating this incredible snowball effect over time.
So it's not just about how much money you put in, but the time you give it to grow. That's where the passive part comes in.
Exactly. The earlier you start, the more time your money has to work its magic. That's why it's so important to start investing as early as you can, even if it's with a small amount, like just $75 a month.
Yeah, this makes me think of all the impulse buys I could have skipped on.
Haha, we've all been there. But hey, the key takeaway is to focus on consistent investing moving forward. The article also talks about how important it is to write out those market fluctuations. It can be tempting to hit that panic button and sell everything when things get a little shaky. But that's where a strategy called dollar cost averaging comes in, or DCA for short.
DCA. So that sounds a lot calmer than trying to time the market perfectly, which always seemed impossible to me anyways. So how does DCA work?
DCA is all about taking the emotion out of investing. You invest a set amount like our $75 at regular intervals. It could be weekly, monthly, whatever works with your budget. When the market dips, you're buying more shares at a lower price. And when the market is soaring, you're buying fewer shares at a higher price. It all averages out over time, smoothing out the ride.
Okay, so DCA is like a built-in shock absorber for your investments. I like that analogy. But DCA alone won't magically get us to a million, right? We need to talk about what we're actually investing in.
You got it. The article recommends some specific places to put your money, starting with S&P 500 index funds. They've historically had pretty solid returns, and they give you a nice slice of the whole U.S. stock market pie.
So instead of trying to pick individual stocks, you're basically betting on the overall success of the U.S. economy.
In a way, yeah. But remember, diversification is key. Don't put all your eggs in one basket. That's where diversified ETFs come in. They spread your risk across even more companies in different industries.
Makes sense. Spread the love around. Then there are growth stocks, companies with high potential for, well, growth. The article mentioned CrowdStrike as an example, but it also talked about how its stock took a major hit at one point.
Yeah, CrowdStrike's an interesting case. Their stock took a nosedive, like a 30% drop, all because of a software error. A lot of investors freaked out and sold at a loss. But guess what? Just a few months later, it bounced back, surging over 50%.
Whoa, talk about a roller coaster. What does that tell us about Merth stocks in general?
Well, growth stocks can be volatile, that's for sure. But that volatility can also create some pretty sweet opportunities. If those investors had just held on to CrowdStrike through that dip, they would have come out way ahead. It's a good reminder that reacting emotionally to those short-term market swings can actually cost you money.
So keep a cool head. Don't get spooked by every little dip or jump on every hot stock tip, right?
You got it. Oh, and speaking of hot tips, the article also mentioned cryptocurrencies. They definitely have potential, but they're high risk. You got to approach those with caution. They shouldn't be the foundation of your portfolio.
So it sounds like diversification and patience are the names of the game here.
You got it. And that brings us back to the big question. Can you really turn $75 into $1 million? With consistent investing, smart choices, and a whole lot of patience, the answer is yes, it is definitely possible.
Okay, I'm starting to see how this all fits together. But I'm curious, are there any ways to speed up the process? Can we turbocharge this journey to a million?
There are definitely some strategies to boost your progress. First, as your income grows, think about bumping up your monthly investment amount. Even a small increase can make a big difference over time thanks to that compounding effect.
So if we can swing it, maybe bump that $75 up to $100 or even more.
Exactly. Another strategy is reinvesting your dividends. Instead of pocketing those earnings, put them right back into your investments to compound even further. It's like giving that snowball an extra push down the hill.
I like it. Put that money to work. But what about staying on top of market trends? How do we make sure our investments are still on the right track?
You don't need to become a day trader or constantly check your portfolio. Just be aware of any major shifts in the market and understand how they might affect your investments. Keep learning, stay curious, and adjust your strategy when you need to.
So continuous learning is key here.
Absolutely. When I was reading this article, what really struck me was the underlying message. Turning $75 into $1 million isn't about luck or some secret formula. It's about discipline and making informed decisions that align with your goals. And it's never too late to start.
That's a great point. I think that's a perfect place to wrap up part one. We've laid the foundation, and now we're ready to see how real people have actually put these principles into action. In part two, we'll be diving into some inspiring success stories and maybe a few cautionary tales to see what we can learn from their experiences. So stay tuned.
Can't wait.
All right, so welcome back to our deep dive into turning $75 into $1 million. In the last part, we talked about like the power of compounding and DCA and building a diversified portfolio, all that good stuff. Now I'm really curious to see how this all actually works out in the real world. Are there like real stories of people actually achieving this?
Oh yeah, there are tons of inspiring stories out there. One that comes to mind is this woman, Sarah. She started investing in her early 20s with just $50 a month.
Wow, even less than our magic $75. So what did she do that was so special?
Sarah, she was incredibly consistent. She picked a low-cost S&P 500 index fund and just kept adding to it month after month, year after year. Like whenever she got a raise, she increased her contributions, and she always reinvested her dividends.
So she was really playing the long game, huh? Trusting in that power of compounding to do its thing. Did it work?
It totally did. Fast forward 30 years, Sarah was able to retire early. He hit that $1 million mark. And now she spends her time traveling and pursuing her passions.
That's amazing. It really shows you that like anyone could potentially do this. It's not about being some like financial genius. It's about discipline and patience.
You got it. It's all about consistency and having a long-term vision. But Sarah's story isn't the only one. Let's talk about John. He started investing a little later in his mid-30s, and he had a bit more to invest each month, around $200. John was a little more adventurous with his portfolio, though. He had some growth stocks in there, even dipped his toes into crypto.
So he was willing to take on a bit more risk for the potential of those like higher returns. Is that a good strategy for everyone?
Not necessarily. You got to remember that John's risk tolerance was higher, and he did his research before investing in anything.
So he wasn't just jumping in blindly.
Nope. He was careful to diversify too, so no single investment had too much power over his portfolio. His story shows that there are like different paths to success, but responsible decision-making is always key.
It's about understanding your own comfort level with risk, right? Not just blindly following someone else's plan.
Exactly. And hey, let's not forget that there can be bumps along the way. Not every story is a smooth ride straight to the top. Take Maria, for example. She started investing in her late 20s, and things were going great until the market took a major downturn.
Oh, ooh. I bet that was pretty scary. What did she do?
Well, she saw her portfolio value drop significantly. And like a lot of people, she started to feel that fear creeping in. But Maria reminded herself that market corrections are normal. They're just part of the investing cycle. So she held on to her investments, trusting in her long-term strategy.
So she resisted the urge to panic and sell everything. That must have taken some serious discipline. Did it pay off?
It did. The market eventually recovered, and her portfolio bounced back stronger than ever. Maria's story really highlights the importance of resilience. Sticking to your plan even when things get tough.
It's like that saying, it's not about timing the market, it's about time in the market.
Exactly. All these stories really illustrate that. The path to $1 million might not always be a straight line. But with consistent investing, smart choices, and a long-term perspective, you can make a huge difference.
These stories are super inspiring, but I know there's got to be another side to this. What about the cautionary tales, the people who made mistakes that we can learn from?
Oh yeah, the cautionary tales, those are important too. It teaches valuable lessons. One common pitfall is chasing those quick riches. We've all seen those flashy ads promising crazy returns with no risk.
Oh, yeah, those too good to be true schemes always sets off my alarm bells.
Trust your gut. Remember, building wealth is a marathon, not a sprint. There are no shortcuts or magic formulas.
So avoid the hype and stick to the proven principles, right? Like DCA, diversification, and patience.
Exactly. And be careful about letting your emotions get the best of you. Fear can make you sell at the worst possible time, And greed can tempt you into risky bets that could backfire big time. You got to make rational, informed decisions based on your goals and your risk tolerance, not your feelings.
So have a plan and stick to it, even when the market throws you a curveball. But how do you stay grounded when everyone around you is like freaking out and making impulsive decisions?
Having a clear investment plan is essential. It's your roadmap, it keeps you focused on your long-term goals, and it helps you navigate all that market volatility. And hey, don't be afraid to ask for help. If you need help creating a plan or understanding some of the more complex stuff, talk to a financial advisor.
So informed decision making and keeping our emotions in check are super important. But what about actually getting started? There are so many different accounts and platforms out there. It can be overwhelming. Where do we even begin?
That's a great question, and it leads us perfectly into the final part of our deep dive. In part 3, we're going to explore the practical steps of actually opening accounts, choosing investments, and setting yourself up for success on your journey to $1 billion. So stick around.
All right, so welcome back to our final part of this deep dive. We've talked about the power of compounding, heard some incredible stories, and learned how to avoid those, like common investing traps. But now I think it's time to get down to brass tacks, you know? How do we actually put all this into action?
All right, so let's turn those inspiring stories and strategies into concrete steps. Let's break down the process of actually getting started with investing.
Perfect, because I think that's what a lot of people listening are thinking right now. Like, okay, I'm ready to take that first step, but where do I even begin?
Right. Well, the first step is figuring out where to put that $75. For most beginners, I usually recommend starting with a tax-advantaged retirement account, something like a 401k or a Roth IRA.
Okay, so a 401k is usually offered through your employer, right? And it lets you contribute pre-tax dollars, which can like lower your overall tax bill. But what about a Roth IRA? What's the advantage there?
With a Roth IRA, you contribute after-tax dollars, but then your earnings grow tax-free. So when you retire and start taking that money out, you won't owe any taxes on those gains.
Ooh, that sounds pretty sweet. So it seems like both options have their perks.
Yeah, it really depends on your individual situation. I'd say do some research, figure out which type of account aligns best with your financial goals and your tax situation.
Makes sense. Do your homework. Okay, so once we've got the account figured out, then comes the fun part, picking our investments. We talked about index funds, ETFs, growth stocks, even a little bit of crypto. Where do we even start with all those choices?
Well, remember, the key is to create a diversified portfolio, one that matches your risk tolerance. If you're more on the conservative side, you might want to lean towards index funds and ETFs. They give you a broad exposure to the market and usually have less volatility.
Okay, so for someone just starting out, maybe a little risk averse, that's a good place to like dip their toes in the water.
Exactly. Now, if you're comfortable with a bit more risk and potentially higher rewards, then you might consider putting a portion of your portfolio into growth stocks. But remember, do your research and be prepared for some ups and downs.
So it's not just picking random companies, there's a strategy involved.
Absolutely. And don't forget about dollar cost averaging. Most investment platforms let you set up automatic contributions from your bank account. That way you're investing consistently no matter what the market's doing.
So we can basically set it and forget it.
Well, not completely forget it. It's good to check in on your investments every now and then, maybe once a year, just to make sure they're still aligned with your goals. And as your life changes, you might need to tweak your strategy a bit.
So it's not about blindly sticking to the same plan forever. It's about being flexible and making smart decisions as you go.
You got it. And while you're at it, stay informed about market trends and economic news. You don't need to become a financial expert or anything, but having a general idea of what's going on can help you make better decisions.
So continuous learning is a big part of this.
Absolutely. And hey, don't hesitate to reach out to a financial advisor if you need help. They can help you create a personalized plan, choose investments, and navigate any of those tricky parts you might run into.
It's good to have that option if you need it. So let's recap our journey here. We started with a big question. Can you really turn $75 into $1 million? What have we learned?
Well, we learned that it is possible, but it's not about magic or luck. It's about making smart choices, investing consistently, and being patient. It's about understanding that power of compounding, embracing that long-term perspective, and staying focused on your goals.
Yeah, we've heard some amazing stories from everyday people, people who achieved financial success through dedication and smart investing. We also saw how important it is to avoid those get-rich-quick schemes and to keep our emotions in check.
And we learned that getting started isn't as scary as it might seem. With the right knowledge and a little effort, anyone can do this.
So to everyone listening out there, remember this. Turning $75 into $1 million is a real possibility. It takes time, it takes discipline, but it's a journey worth taking.
Couldn't have said it better myself. Remember, the best time to start was yesterday. The next best time is today. Take that first step and let the magic of compounding do its thing.
That's a fantastic way to end this deep dive. Thank you so much for joining us. We hope you feel empowered to take control of your financial future and start building your own path to a million. Until next time, keep learning, keep growing, and keep investing in yourselves.